Now as I said earlier on, there are two aspects to most of the accounting that we do. There's the actual accounting. So in this case, the actual accounting is fairly straightforward. You show a gain or loss if the hedge thing has changed in value, and you change the value of the asset or liability. But it's actually picking up what's happened, which is important, and actually how to calculate that gain or loss, which is an important thing here. So we'll spend some time on that. So we have a company that on the 15th of June, so let's draw up a timeline here. So there are three dates which we're using in this example. So the 15th of June is when the purchase happened. That is the financial year end, and this is when they were paid. So for the underlying, that is exactly, this first bit is obviously different numbers, but what you did last week, or we did last week. So we have some sort of overseas purchase. In this case, when they decided to buy and they actually bought, that happened on the same day, financial year end, and then they paid off that foreign currency account payable. The amount was $1 million US, and they paid it all. Now this is the hedge bit. So that's the underlying, and this is the hedge. Because of concerns about movements in foreign exchange rates on the 15th of June, so on this date, so the same date that they actually purchased the batteries, they actually entered into a forward rate contract. So the hedge begins at that point as well. Where is it? Contract in US dollars with a foreign exchange broker, so to receive $1 million US on the 30th of August 2014. So this is when settlement is going to take place. So when they talk about a forward being for a specified quantity, $1 million, so they're looking to buy $1 million US, so they're getting some sort of asset, they're going to buy some sort of asset on a specified future date, the 30th of August, at a specified price, which is $1 US equals 1.25 Australian. Maybe good to try to think about these foreign currencies not as cash, but think about it as an asset. Think about it as just a thing that you're buying. So you're buying this thing, and that thing is worth, when you go to pay for it on the 30th of August, is worth 1.25 million Australian. That is what, so this is an important bit, that 1.25 is the rate that you have locked in. At that point, you don't care what happens to foreign exchange rates. The Australian dollar could go through the floor, and you are still going to be getting $1 million US and paying 1.25 for it. Now, when I say you're going to be receiving it, you're not going to actually physically get $1 million from the broker, and you're not going to be actually giving him $1.25 million Australian. You actually just settle it out. But we'll just talk about the payable and the receivable as, just imagine you did have that payable and receivable happen. Yes?
Once the hedge contract's broken, can it be secured, like a mortgage account?
So when you say broken, like that one of the parties just walks...
Say the AD really fell, appreciated,
yep.
And the lender of the hedge
Walk.
refuses to pay.
Oh, yeah, we're not going to, well, yeah, we're just assuming that that's not going to happen. I mean, like, yeah, I mean, there's that's kind of getting into counterparty risk. So, I mean, there is obviously, look, there's risk in everything in life, and yeah, that could happen. We're just assuming that the other side will actually sort of pony up.
Okay.
So, yeah.
Can a hedge be secured?
Don't know if a hedge can be secure. I mean, you can take out, I mean, I don't know whether it's necessarily secured. I know you can, whether against a hedge, you can take out insurance on things, and that may be a way to do it. But in a sense, then you're worried about so you're trying to mitigate a certain sort of risk, which is foreign currency risk, and then you're then worried about counterparty risk with the other party won't sort of come to the table. To an extent, if it's done through just with another party, there's obviously a greater likelihood of that risk. I mean, it's still not great. If it's run through a futures exchange, then that shouldn't there'll be deposits involved. It probably is less likely that there'd be concern there. But for us here and now, we're just assuming that won't happen. Like with a lot of what we're doing, we're simplifying the realities a great deal, but it's to get the idea across. But I mean, that's a fair question. So we have this set up. Let's assume that nobody balks at the other side, balks at it. We also then have been given spot and forward rates. So these are rates of if you went down, and obviously reality is not like this. If you see, and everyone knows it when you go traveling, you see, oh yeah, the Australian dollar is above parity, go down to try to convert money and you get like 0.95. You never get the rates that are actually given. And there's obviously then differences between the buying and selling rates. So we're assuming all that away just for simplification purposes, and it still serves our purpose for what we're trying to do here. The 15th of June 2014, the Aussie is actually, well, the US dollar is buying 1.21. On the 30th of June, the financial year, and the spot rate at that date is 1 to 1.24, and it's 1 to 1.32 on the 30th of August. So the forward rates, what this is at the 15th of June, so at this point, you're looking at delivery at this point in time. So in effect, this is kind of like future US dollars. A future US dollar is trading at 1.25 on that particular date, which is what you've locked it in at. You've locked in that contract at 1.25. When you roll along to the financial year end, that's 1 to 1.28. So there has been a movement in the forward rates. And then that forward rate has changed again, and what you'll see is it, theoretically should end up being the same, because that is the spot rate. So that is the rate on the 30th of August in this, for a spot delivery. At the 30th of August, which is the same date. So that's forward rate for delivery on the 30th of August, but it is the 30th of August, so that should ultimately work down to end up to be the same as the spot rate on that time. Now, how do we figure out the fair value of the hedge? So on the 15th of the 6th, we have two things, because we've entered into a contract, and assuming the other party is all good for it, we have a receivable of, we are going to receive $1 million US in the future. So that's kind of like, and we are going to pay Aussie dollars 1.25 million, and that'll happen in the future as well. 30th of June. At the 30th of June, we're still going to receive US dollars 1 million in the future. And the payable is still AUD 1.25. And on the 30th of August, we're going to receive, and I'm using receive loosely there because we're not actually going to get it. So you can see, because we've locked this in, this is happening all the time. Like, we're receiving $1 million in the future. We're receiving $1 million. Like, that's what we're receiving. That is locked in. What we are paying, the 1.25 million Aussie, that's locked in. But we can't have US dollars on our balance sheet, because that's in effect, that is in effect a receivable, that is in effect a payable. We've got a contract that's set up, and if you look at the definitions of financial asset and financial liability, those are financial assets and financial liabilities. What we have to do is look at the value of that $1 million US. And that future $1 million US on the 15th of June is trading at 1.25. So the Aussie equivalent of that is 1.25. That's already an Aussie. At that point in time, they're the same. Now, we don't show 1.25 million Australian and we don't show a $1.25 million financial asset and a $1.25 million financial liability. We actually net them out and just show the marginal effect. Reason being, there might be a couple of people that fit the bill. I need 2 people in this room who know each other. Okay, you guys know each other. What are your names? Oh, bless you. I should know your name because you picked up, sorry. Jerome? Is that it? Cool. And Alan. Yeah, I should know. Did you just pick up your papers? I should know about it. Anyway. Jerome and Alan, you guys know each other? Know each other well enough that you lend each other money? No, okay. Fair enough. But let's imagine you did know each other well enough that you lend each other money. Now, you should pay him back because he works for the police, so I wouldn't get on his wrong side. You owe him $50. So Alan owes Jerome $50. Jerome owes Alan $40. Are you actually going to pull out your wallet and give him 50 and then you're going to pull out your wallet and give you 40? What's the more likely thing that you're going to do?
$10.
Yeah, you're just going to give him $10. You net out because it's the same like you've got the same counterparty in both situations. Now, a difference exists if, Jason. If Jason owes Alan $50 and Alan owes Jerome 40, I think that's how, yeah, it's going either way. In that case, we've got different counterparties, and you can't net that off and say, well, I actually have a net owing to me of $10 because you do, because you've got 50 coming in and 40 going out. They're with different parties, so you can't net that situation out. So when you have, for financial assets and financial liabilities, there are particular circumstances when you can set off, and one of those is, and basically you can only do it when you have the same counterparty to either side of that or of different transactions. So that's what's happened here. So imagine if changing it now from 15, like from you guys who just lent and borrowed money for each other to Alan is the company who is worried about foreign exchange risk and Jerome is the counterparty to that. Jerome, you're not actually going to give him $1 million US on the 30th of August. And Alan, you're not actually going to give him $1.25 million Australian on the 30th of August. What you're going to do is you're just going to let it run through and then on the 30th of August figure out what the value of that US dollar is, what the value of $1 million US is, figure out who's slightly up on the arrangement, and then just give money one way or the other. So remind me when we come to the end of this so Alan, you're the company. Just remind me of that if I forget. So at this point in time, those things are worth the same. They net out and we show nothing on the balance sheet. When we come to the 30th of August, that 1.25 Australian is locked in. That doesn't change. It's still worth $1.25 million Australian. But the foreign exchange rate, or the forward rate for it, has moved to 1.28. So that means the receivable, so the future US dollars, which Alan is going to get, you're still going to get $1 million US, but that is now worth $1.28 million. You're only paying 1.25. The marginal then is the equivalent of Jerome giving you $30,000. So that's 0.03. And then when we come through to the final date when settlement happens, that $1 million is now worth 1.32. The 1.25 you've got to pay Jerome is now worth 1.25 because it's in Aussie already. And that difference is $70,000. So that's the equivalent of the $50 and $40 exchange that never happened. That's Alan just going, well, hang on, I'm not going to give you $1 million just to get, I'm not going to give you 1.25 million Australian to get the $1 million US from you. That $1 million US is now worth 1.32. Just give me $70,000 and we'll call it square. And that's the situation that would happen. So you just pick up, and we'll go to the accounting for a second, that's the amount that actually gets settled. So we turn over to the hedge position. I'm I'm going to really briefly run through the underlying position so everyone's just aware of it, but this is exactly the same sort of material that we did last week. At the 15th of June, we bought something, we have a financial year end, we adjust the payable, we get to the payment and we pay it off. So the inventory and the foreign currency payable gets recognized at 1.21 because that's the spot rate at that date. We make adjustments to it. Now the Aussie dollar has weakened, so it's gone from 1.21 to 1.24. So we pick up a loss of 30,000, the payable increases. We come down, it's gone from 1.24 to 1.32. That's another loss, and it's $80,000. And when we come to pay it, if we paid it up front, we would have paid $1.21 million. But because we let it slide for a little bit, we've actually ended up paying more for it. And we've actually stumped up $1.32 million to pay for that inventory. So that's the cash that got paid. If you're ever doing these sort of questions, I would absolutely advocate doing them in columns. So you've got the underlying position, and then on the same dates do the hedge position next to it. So you can much more easily see what's going on in the underlying and then what's going on in the hedge. It just makes the matching up a little bit easier to do. When you set the hedge up, there's no entry here because as we worked out in the previous slide, it's 1.25, 1.25 gives you 0. There's nothing you show. This is then when it turns into 1.28 to 1.25, gives you $30,000. So the receivable is currently 1.28, the payable is 1.25. The difference is recognized as a financial asset because for Alan, he is now going to exchange financial assets and he is in a favorable position. You are looking okay at that point in time. If Jerome was doing this on his side of the equation, he is in an unfavorable position and he would recognize a financial liability. So you pick up, this is a financial asset. You pick up that change as a gain. You can see how we've got a loss and we've got a gain. That's what's happening. We're actually matching up those two things. Now, it just so happens in this first period that they match up perfectly. That's not always going to happen, but it did here. We then go to the second period, or the second part of it. 1.32 is the receivable versus 1.25, gives you $70,000 is the difference. No, we're not actually putting $70,000 because that is actually what the financial asset is worth. So we've got to go from, it was at 30, and we now roll it up to the 70. So we're just picking up that difference. And so as the final financial asset is getting increased by $40,000, we pick up another gain. And that, the gain and loss match out, well, okay, they match up, but they're not obviously the same number. So the receivable is worked out, the difference is recognized as a financial asset, and the previous balance is adjusted to reflect that. And then this is Alan receiving money from Jerome at the end, so they settle it. And you get $70,000 in cash, so Alan does. And the forward rate contract, which was at $70,000, is now gone because it's been dealt with. Yeah, the counterparty's lost money and provides a net difference. And what you can see is the amount that we locked in, or the rate that we locked in, was 1.25. We have that 1.32. We have 70 coming in. We have effectively paid $1.25 million for this inventory. And that's the point of the hedge, is it, in this case, the hedge made us money. And that's good. I mean, you know, that's a good thing. But the point is not necessarily for the hedge to make money. The point is for the hedge to lock in the rate in advance. So you know that's what you're paying. Yeah, and that's working it through. So we can see that the first block of time, in the underlying position, we've made a loss of 30,000. And in the second period of time, we've made a loss of 80,000. So that would be a total loss of 110. So if we hadn't done anything at all, we lost $110,000. Now the thing is, we don't know that was going to happen beforehand. We might have actually ended up making a profit on it because the rates moved well for us. But the thing is, we don't know that before it happens. Christ, if we knew the future, I think the damage you could do on the betting markets, I mean, if you knew what was going to happen. But we don't know the future, and that's why hedging exists. We make $30,000 profit on the hedge. We make $40,000 here, so we've made $70,000. So you can see that nets out at 0, nets out at minus 40. So we've also become a lot less volatile. Instead of having it's going sort of a swing down to 30 and then a bigger swing down to 80, we've had nothing at all and then minus 40. So we've reduced the profit and loss effect of the foreign exchange movements. It hasn't wiped it out completely, but it has had an effect on it. Now, before we get into cash flows, because I know that is an important part of what we want to do, I just want to show you a really quick article, and I'll post this up tomorrow.